take his time.
All right, everybody. Well, hey, we are back, and we have got a rock star, a real investor in action. Button taking names. A friend of mine who was actually one of our first people to be in the mastermind back, one of 10, 12 people, spending 8 or 9 days in Davenport, Florida, buying us just stuff. And she and her business partner, Aaliyah Ott Carter now, since Aaliyah's been married, now I get that right, have gone out and done some amazing things. I'm so proud of what they're doing, not only for them, their own portfolio, but they're also helping a lot of other investors out there and just doing a rock star job. So you are in for a pleasure to wrap up day 2 with our good friend Terri Garner out there. So what's up, Terri?
Hey, it's warm here, like I was saying, so that's why I've got the summer look going. So we'll get through this, and I know I'm at the end of the day, so I appreciate everyone. First of all, I appreciate everyone just doing this, trying to better themselves by taking time out of their weekend during the summer. I think that's awesome. So yeah, and I will try to keep this lively to keep everyone's attention going.
Well, I don't think you have a problem with that at all. We've got a great group of people who have stuck around. We had a lot of people watching this on live stream, people not only from all across the United States, but we got quite a few international people watching this too from abroad in different countries. Israel, New Zealand, London, Spain, Germany, just to name a few of some of our international people that are watching this. So excited to have you share your expertise and the fact that you guys, you're doing a lot of amazing things, been doing a lot of amazing things the last decade of stuff, and then transitioned and kind of rolling with the markets, right?
Yeah, exactly. You got to follow the markets, and you have to adapt and change with the winds wherever they blow you. So
exactly.
Yeah.
So you've got a PowerPoint you want to pull up there real fast? We'll dive into that.
I do. Let me pull it up. Okay. I've got it called up.
So you just got it on the Zoom thing. You'll see where it says share. Hit share screen. The control panel for Zoom here.
Okay. There we go. Share.
And then I should pop up your PowerPoint is one of the things you probably have open your screen. So select the PowerPoint. There you go.
All right. Are we there?
Put that in presentation mode, and you're good to go. Perfect. Look at that.
Okay. All right. I'm going to leave my glasses on so I can see. So hopefully I'm not getting too much glare. So sorry, everyone, for that. But I want to talk to you today. I've got really kind of 2 different things that I'm going to talk to you about. The first is self-storage investing, and I understand there's been some others. Scott Myers, I actually know him. I've taken actually one of his courses back in the day on self-storage investing. So I'll just tell you a little bit about our journey and how our take on the storage business. But then I'm also going to spend a large portion of the time on raising money and talking about syndications. There's some key lessons that we have learned certainly over the years. So want to dive into that because that applies to everyone. I know storage is a little bit of a niche, especially if you're buying notes, but you might end up having a note that has a storage facility. So it's a good thing to understand about them and at least to have heard what the asset class is all about so that you have that understanding if that ever comes across in your investing in the future. So let me dive right in because I know we have a limited time and I know it's also getting late in the day. First of all, just want to mention myself and my partner, Aaliyah Ott Carter. We are co-founders of Investors in Action. We also manage the Capital Storage Fund, which is a syndicated fund. We've done over 100 plus real estate deals and notes, both performing and non-performing. And for the last several years or so, we've been focused on self-storage. Now, our investing journey, and you were talking, Scott, about blowing with the wind and changing courses. Well, that's actually what we've done too. And I think most people go through this. So if this is something you're experiencing, you know, go with the wind, go where your investing journey takes you. It is not a straight line, but you will get there. Our end goal is to get to that all-encompassing financial freedom point, because we want to retire, right? We want to do what we want, when we want, with whom we want. So we want to get to that financial freedom day. Now, our story is, Aaliyah and I met at a real estate investment club in 2009. And if you haven't joined any kind of a real estate investment club, I really highly recommend you do it. They're really not that much money. You get a lot of different people that are, you know, from newbies all the way to experienced, people that know how to find deals, people that have cash, and it's a great way to meet people. And that's where Aaliyah and I met. We started out doing fix and flips. And then we started lending private money on those fix and flips, and we were essentially creating performing notes. And we did that, here in Southern California for about 3 years. This was back in 2010 to 13. A lot of foreclosures going on, so there was a plethora of inventory, and we were taking advantage of that. So we had a great run. By 2014, we actually had a perfect winning streak, meaning that we would raise money from investors, we would loan it to rehabbers to do a fix and flip, and then that would get sold and we would send the money back. And we never had any problems with any of that. All of our deals were doing great. Our biggest home run was a $250,000 profit, which is a nice chunk of change to put in your pocket. And we were doing really great until we had one of our rehabbers that happened to own 2 properties bailed on us. We had 2 loans on both of these properties. They were in the same complex. It was like a golf course community. And in order to get those properties back, we had a deed in lieu of foreclosure that we had signed in advance. But this guy had some judgments on one of the properties that popped up the day before we were going to file the deed in lieu of foreclosure. So in order to get rid of those judgments, I think it was for child support or, I don't know, something fun like that, we actually had to take him through foreclosure. While we were going through that foreclosure process, we had a slab leak, a busted pipe, we had mold going on. These properties were in Palm Springs. It gets hot. This is over the summer. Just, you know, kind of the perfect storm, one thing after another happening on this property. What we did, and why I share this story, is while this was going on, we actually came out of our own pockets ourselves to keep our investors whole. We kept making payments to them. We used our money to fix up the shoddy workmanship. Another key learning here, we did have an inspector go out before we released funds. So at every point of the rehab, an inspector would go out, check what was going on, send us photos, say, yes, everything looks good, and then the funds would get released. The problem was they had put in these, what looked like beautiful travertine floors. But when we actually got out there to see it ourselves, it was all uneven. And I don't know how the inspector actually approved this. So we fired him for sure. But we had a lot of key lessons on this one. And again, going back to what I think the crux of the story is, we kept our investors whole. And that's key, especially when we're going to talk in the second half of this about raising money, because I believe had we not done that, we would have lost those investors. And those investors still invest with us today because they know what we went through. We were telling them what was going on, but we kept making payments to them. We had to keep a first position loan current. We had to keep HOA dues current. A lot going on with this. So after this happened, we were trying to ask ourselves, what can we do to avoid this in the future? And we decided that we wanted to take more control of both sides of the equation. So not just do the lending, but also be a part of the ownership. And so that's what we did. At that point, we started to get into storage properties. We have a third partner, Al. You see him there in the middle of the picture. And the 3 of us now co-own 13 storage facilities in secondary and tertiary markets. So we don't go into a primary like some of the bigger markets. We actually like the secondary and tertiary markets because they're not as competitive and they're not as overbuilt with storage. What we do then is we raise money from private investors and then we loan that to our own property. So again, we're kind of working both sides of the equation. What we do when we find a storage property is we look for something that's half full. We want to make sure it has at least 250 units or more. Anything less than that really is just a waste of time for us because it's the same work to manage and upgrade and fulfill the property as for the lower ones it is for the upper ones. So we want bigger numbers. So that's why we set a minimum at 250 units. And we look for these properties in the middle of the country. The coasts are really pretty expensive. So most of our properties are anywhere from Michigan all the way down to Texas, across to Louisiana, and over into the South Georgia and North Carolina. So that's primarily where we do business. We just feel we can get better deals in those sections of the country. And we typically look for mom and pop properties. Now, storage, and I don't know if Scott Myers went into this, but storage had a big boom in the 70s and 80s. There was a lot of construction going on back then. And so typically what you find today are mom and pop that built the facility and have been sitting behind the desk actually running it for years, and they're getting older. They want to retire. Perhaps they passed away and left it to the kids, and the kids want nothing to do with it. That's the family business. It took mom and dad away all these years. We want nothing to do with it. So that's what we look for. Those are really good deals. They come in singles typically, so we're not buying a huge portfolio, but we're buying one, possibly two at a time. And we look for those that are maybe half full, where we get some cash flow coming in on day one, but there's still an opportunity to add value to them so we can up the value of them and then sell them. And I'll show you a case study of one of our properties here in a minute. So why storage? I'm going to go through the top 10 list, and I don't know if you remember like the Dave Letterman days of old when he was on nighttime TV, but we're going to go through the top 10 of why we like storage. So number 10, high demand. The fastest.
Top 10, you can have a drum roll.
Yeah, hey, we get music accompaniment. Great. Yeah, I love it. So number 10, high demand. Self-storage really is the fastest growing segment of all the commercial real estate industry in the last 40 years. It has 90% occupancy rates across the board. So when you're talking about how full it is and how much money you can demand, there really is a lot of people that like storage. People like their stuff, right? They don't want to get rid of their stuff, especially here in the U.S. And I know there's other countries on the call or listening to this. I don't know how it is there, but here in the U.S., we tend to hang on to our stuff. So demand typically outweighs supplies in most markets, especially the secondary and tertiary markets. Number 9, it's recession resistant. We know we had the big recession back in 2008, 2009 into 2010. And you can see here from this graph that, yeah, it dipped like everything dipped, but it didn't really go way down. And when you think about this, people unfortunately were losing their homes and they were downsizing because of that, going from maybe a bigger property they had, whether they were foreclosed upon or just underwater and had to sell, going to something smaller. They still wanted to hang on to their stuff. So they moved it. As they're moving to a smaller residence, they're getting storage units. So again, people like their stuff, and we found that even with that recession, and we could have another one coming up, right? But we're not afraid of it as long as you buy the property right and manage it correctly. It really is, we don't say recession proof, but we say recession resistant. Number 8, what we absolutely love is that our tenants are things that you see in this photo. They are very quiet. They don't complain. They don't complain that the neighbor's dog is barking because our tenants are boxes and lamps and chairs, and they just sit there. So we have none of those. Say, let's say you have an apartment complex or a mobile home park or even a single family home, and there's a disturbance going on with the neighbors. We don't have any of those kinds of issues. They really are very easy to deal with because they are very quiet. Number 7, lower expenses and repairs. This picture, what you see here, that is the tool we need to repair our properties. So when a tenant moves out, we don't have to do carpet, we don't have to do paint, we don't have to ding the dings in the door and repair the lighting fixtures that aren't working properly. We use our broom or an air blower, and we go in there and we sweep it out. We clean out the junk. If there is junk in it, we might have to hire like a high school kid, pay them $50 to come in and cart the stuff away. But it's very, very cheap, very reasonable, and very quick to turn around. Number 6, easy management. Now, we've already kind of touched on this, but one thing I want to add here is that because our tenants are the boxes and things, that's what actually resides in. The actual people that sign the leases, we don't interact with them. Most of them will come in when they first put their stuff in. They might come maybe once a month, and then they come in whenever they're going to move out. So we just don't have our property managers that are on the property just don't have to deal with the kinds of issues that you might have to deal with at an apartment complex or a single family rental for that matter, or mobile home parks or whatever asset class you're managing. Ease of dealing with delinquencies. Now, this is really great because you don't have anybody living in these units. There are actually fewer regulations to deal with. You have no fair housing laws because you don't have people inside. You don't have to go through a foreclosure. You don't have to go through an eviction. Not necessarily. There are some cases. But you can, as soon as somebody doesn't make a payment, within a few days, you can lock them out. And you see a picture of the lock there. It's called an overlock. You can lock them out of the contents of their unit. And the laws are different state by state. There is no overarching federal law, but each state has what's called a lien law, L-I-E-N, a lien law, and that governs the requirements for dealing with these delinquencies or putting a lien onto the contents of what people have in their unit when they haven't paid you. Now, within a few days, you can put this lock on, which means they can't get to their stuff and take it out. And then you start the process of, you have to mail them. And again, this is state by state, but typically you have to mail them several different times. You have to post in a legal newspaper for usually 2 subsequent weeks. And then once you get to that point, you can have storage wars. Now, I don't know if you've seen the TV show, certainly we have it here in the U.S., called Storage Wars, where they show people coming in and they have an auctioneer auctioning off the locker, and people come to see what they have in there. They can't go into it, so it's kind of a little bit of a treasure hunt, right? But they make a bid on that unit, and then they own, once the cash changes hands, then they own the contents of it. So we do that as well whenever you get someone who hasn't paid. And we've done both live auctions, as you see there in one photo, and online auctions. Live auctions are really great when you have a lot of storage units that are needed to be turned over. So we will typically only do live auctions when we first buy a property, and maybe there are like 20 units that are delinquent. You want many of them because you want to draw a crowd to it. However, when we have only 1 or 2 units that need to be auctioned, we'll do those online. They're very simple to run. We can get to them very quickly. The buyers actually see photos of what's in the locker. They can get kind of a sense of what it is, and then the auction counts down and they can bid on it. So both ways are very effective. And it's a way for us to get our money back and recoup some of the losses. Number 4, going back to our top 10, less liability. Because the actual renters spend less time on our property and the time they're there is much lower, there's really less liability. They are also responsible for insuring their own contents of the unit. So we provide property insurance or building insurance on the actual walls, but it's a little bit like condominiums that they get renter's insurance for their actual contents which are in those walls. And I already mentioned fair housing laws don't apply, which is great. So number 3, financing. Financing is typically easier on storage properties. One, because it's an easy to understand business. It's very straightforward. You've got 4 walls, you've got a roll-up door. And lenders, commercial lenders, tend to be less concerned about storage facilities than they are other asset classes. They actually really like storage facilities because their default rates tend to be a lot lower than mobile home parks or apartment complexes. And we always ask for seller financing. Now, this applies across the board with real estate, right? Anything that you're doing. When you're buying a property, single family or commercial or otherwise, it's always good to see if the owner is willing to take their payments over time instead of taking a one lump payment up front. And we sell this to them as saying, hey, look, you can still get some cash flow without having the operational headaches of owning the property. And I would say about half of our properties are seller financed. And those are great because we can usually get much better terms, like 5% interest is typically what we get, usually for about 7 years. That's what we ask, sometimes 5 to 7 years until it'll balloon. But that gives us time to actually fix up the property. Then we can refinance and pay them off at the end of that period. Number 2, appreciation. So this is, any commercial asset really has this advantage over some of the single family assets. And that is, with single families, you have to wait for the market to go up or down to help determine the value. Now you can add in granite countertops or fix things up and add value that way. But overall, the market conditions are going to kind of keep you in a certain spot. With commercial, you're not dependent, you're a little bit dependent on market, but most of it is dependent on what you do yourself. So by drastically improving the value of the property, by increasing income or by decreasing expenses, you can force that appreciation up as fast as you can make it happen. And I'll go into a couple of numbers on this just to share with you, and you'll see it in the case study I have for you too. But number 1, the final, number 1, top 10 reason why we like storage is because it has reliable cash flow. The average person will rent for 12 months. So yeah, you're going to get those that come in and they might be there very short term for a month or 2, maybe 3, and then they're out. But we also have those that have been with us for years. We actually have a property in Michigan that the person has now moved to Florida, doesn't even remember what he has in his unit and pays us $100 a month. And he's been begging us, would you please just cut off my lock and tell me what I have in there? And we can't do that legally until he goes into a default situation. Then we follow the lien laws of Michigan. But we're like, sorry, sir, we can't do that. And he keeps paying us $100. So we get a lot of long-term lifers like that. So we love the cash flow of this business. And in summary, everything I just described, all 10 are right here on this slide. And you can see why we like storage. It ticks all of those boxes. So I want to talk about the case study, but before I do that, I just want to make sure everybody is along for the ride on some of the terms. Now, if you're just into buying notes for single family homes, pay attention to this anyway, because at some point in time, you're going to come across some commercial properties. You're going to hear these terms, and it really behooves you to know what these terms are. So I'll try to walk you through them. For those that are already familiar with it, just hang out with me and you might pick up just a couple of little perspectives that are different. So we're going to start with net operating income. Net operating income is very simple. It's income minus expenses. It's the cash flow that comes in each month. However, it does not include any mortgage or loan payments or capital improvements to the property. So it does include income from rent, any late fees, merchandise sales, anything else, any other value adds that you can add to the property. But the expenses are only going to include the operational expenses. That's why it's called net operating income. So it's as if you purchased the property with all cash. Now, we take that net operating income and you divide it by the sales price of what you purchased the property. That's called the capitalization rate. So maybe you've heard this term called cap rate. All this is, if you think about it, the net operating income is just the income that you make month over month, and you're going to annualize that over a period of a year. You're going to divide that about the money that went out. So you've got money in over money went out for the purchase of the property. And that is your equation for return on investment. You're just not considering that mortgage payment. So it's what is your rate of return on this investment as if you bought it with all cash. So a couple of examples. What this does is it allows you to compare several different properties without actually having to look at, since you're not affected by market conditions, you compare these several different properties across the board, even if they might have different cash flow streams coming in. So in this example, you see we've got 3 different properties here. Each one is bringing in the same net operating income, $90,000 a year, but we have different sale prices for each. Now, obviously, the best deal is going to be the one, since they're all bringing in the same amount of money, the best deal is going to be the one you purchase for the least amount of money, which is property number 2 at $800,000. Well, you can see by calculating that cap rate equation, that has the highest cap rate. So you're capitalizing your money at the highest use compared to the other properties. So when we talk about cap rate, the higher the better. Now, cap rates around the country vary, and I apologize, I don't have this on a worldwide scale, but I do have it for the U.S. And you can see just as kind of generalizations there across the board what the current cap rates are. Now, you could actually drill down further. So, for example, in the Midwest, you could drill down further to Chicago. You could drill down further into some of the micro markets of Chicago. And you can find a lot of that information at the 2 websites I listed down there at the bottom, marketsmillichat.com. They have a lot of great information, a lot of great reports, and whether it's on storage or apartments or mobile home parks or just the information of what's going on around the country. So even for single family homes, I would encourage you to check that out. Some really, really good information. Now, determining the current value of a property. As I mentioned, residential properties are valued based on comps. Commercial properties, we can control the appreciation by increasing the net operating income. So we have our equation that we just talked about, cap rate, which is the annual net operating income over purchase price. If you think about purchase price really just as the value of the property that when you're buying it today, you can change that out. Now we rearrange the equation, and the value is equal to the annual net operating income divided by the cap rate, and that is the market cap rate, that average market cap rate of the map that we just looked at. So you take the average of what is going on around the country, and all the averages is like every time there's a sale in that market, they're going to look at what the operating income, net operating income over the price was, and that's the cap rate, and then you average those, and that's your average for that market. So, again, the key point here is, if you didn't follow any of the other discussion, is just to realize that by increasing income and decreasing expenses, you can very quickly, as fast as you can do those things, whether it's 1 month or 1 year or 2 years, 3 years, however fast you can do it, you can get the value of that property up. So let's look at an example. This was actually our first property that we bought in 2014. It's in a town called Owosso, Michigan. It's 30 miles outside of Flint, Michigan. We've all heard a lot about Flint, but I tell you, we love this property. This is very much a micro climate of that market, a micro market within that market. The population is 100,000, which we want at least 50,000 or more, because you want to have the bodies that are going to be interested in renting. The average income is 31,000, and it's a very working class. So we like to have at least 30,000 as our minimum for what the average income is, to, again, make sure that it can support our prices. Now, this particular property had 273 units. It also had a number of parking spaces, and it had 3 apartment complexes and a retail space that was rented out as a dance studio. So in addition to the storage units, we also had other multi-use. We had the apartments that we could rent out. So we had a lot of possibilities, and we have a lot of possibilities for streams of income. So that's why we love this property. The occupancy when we took it over was 67%. Again, we look for occupancy between 50 to 70% as a sweet spot, so that we have money coming in on day one, but we have room to add value. We purchased it for $635,000. Now, this is what the prior owner owed on their mortgage. So we went in already knowing it was going to be valued more than this, but we asked them, will you take what you owe on the property? And they said yes. So we got it for $635,000. We got a commercial loan for 65% of that value. And then we raised the balance of the money, so basically the down payment, via investor capital. What we did to the property, and this is pretty typical for what we do across the board, we had to do some roof repairs. We fixed the gate. Security is the utmost importance for storage property. You want a fence and you want a good security gate. You also want lights. So we didn't need to do that on this one, but we do that if we feel it's too dark. Cleaned up the weeds. That's simple, right? That's just some Roundup and some weed whackers, and you're done after the afternoon. And we improved the signage. Now, this seems silly, but you wonder why the occupancy is lower if you don't have good signage. You want to get that street traffic. You want to make sure storage is big and large. We don't care that Owosso is big and large. We want storage to be big and large. And you also want to make sure your phone number is visible. It seems like I shouldn't even have to mention that, but you would be surprised. We actually had one property that had a phone number on their sign, and it went to a whole different company. So again, they're wondering why they're not getting renters. It's very simple things. It's a simple business. You just got to put it to work. Value add things that we did. We extended the hours to include weekends. Typically, when we take them over, we've got one property manager working Monday through Friday. And if the people want to move in or out on Saturdays. So we always add a part-timer to cover our weekend work and maybe have an overlap of another day in there. We also will hire a call center, and that provides us 24/7 coverage. People can pay their bills by just calling into the number, and we always have a live body through this call service to answer the phone. We also added U-Haul trucks. So again, we do this to every single property. Now, and this is something to think about, even if you're not planning on doing storage, it's good to think about what are some complementary businesses that you can bring into your investing business that will help add value. So for us, we have these storage properties. Well, we bring in U-Haul trucks, and then we earn a commission. U-Haul still owns them and insures them and operates them, but we just take care of the transaction, the business transaction, and we make a commission on every one we sell. Also, we now have these big orange bright trucks sitting in front of our properties, and they attract attention, and it's a name brand that people recognize. So sometimes we just bring in the trucks and we hear people come in, oh, I didn't even know you were here. I saw your U-Haul truck, came to rent a U-Haul truck, but you know what, I need storage as well. So there are two complementary businesses that go hand in hand. We also, at our offices, we sell boxes and packing supplies for obvious reasons. And if there is any kind of space on the property, a lawn, or even just room along the fence up and down and around the property, we will rent that out for RV and boat and other vehicle storage. And we make sure we advertise that. And again, because no one's living on the property, you don't have to worry so much. As long as the vehicles aren't in someone's way of accessing their unit, it's okay to have them neatly lined up along a fence, for example. So let's just quickly look at the numbers on this case study, and then we're going to move on and transition into more finding private money. Again, the occupancy on this one initially was at 67%. After 24 months, we had it up to 92%. We moved the net operating income from $72,000 a year up to $137,000 a year. And that changed our value. Again, we purchased it at $635,000, but we had an appraised value after 24 months of $1.9 million. Now, we were doing a refinance to pay off the seller financing loan to pay off the commercial loan that we had on the property. So we did get an appraisal. But at any point in time, you can calculate what the value is by that equation that we had looked at. So if we didn't have appraisal, we could have just used what the average market cap rates were in the area, and you come up with a very, very similar number. So what does that mean to us? A potential profit, if we were going to turn around and sell the property within 2 years, a potential profit of $1.27 million. So that's a pretty nice payday. And granted, it takes a couple of years to get up to that point, but the property, again, is making income from day one so that we can pay our investors. And then when we sell, we pay off the investors, or when we refinance, we pay off the investors. And in this case, we refinance, we're left with the property, and we're keeping it because we get cash flow of $6,000 a month. And now it's pretty much self-sustains itself. Yeah, some issues come up every now and then, but we've got a property manager in place that works, and it's very, very smooth running for us. So that's storage. If you are interested in learning more, there's a lot of ins and outs. Feel free to check out investorsinaction.com/learn. We do have a success kit and some other things. Success kit is $497, and we have another program, I think that's just under $1,000. So if you're interested, check that out. All right, let me get on then to the second half, and I'm just going to do a time check here to make sure, see where I'm at. Okay, I want to get into this.
You're awesome.
Because this is very important for everybody, no matter what you're doing in any kind of investment or asset class. So raising private money. First of all, the keys to attracting private money. And again, let me just back up, and I mentioned it at the beginning, but I'll just highlight it again. Aaliyah and I, with Investors in Action, we actually ran this as a lending company. So what we did is we worked with a licensed broker that had a mortgage license, and that they could actually transact certain pieces of information, but we basically took in private money from people and then we loaned it out. So we have been doing this now for, since 2012. So quite a long time. What we have found out, these are the keys to attracting money. The investors will lend to people that they like and trust. So this is so important. You don't want to be overly aggressive. You want to be human, right? Nobody wants to work with somebody that they think is a robot or is just reading some kind of a canned script. You need to be you, and people can sense through that, right? They can tell when you're making something up and just saying a canned line, or if you're being authentically who you are. So just be you, be real, and approach it as if you would, this is a friend or a colleague. Be honest and believable. That goes without saying. Have a little skin in the game. This usually builds trust. Many investors will come to ask us and we'll say, well, okay, I'm putting up all this money. What are you doing? How do I know that you're not going to walk away from this deal, that I've got all my money in it, that if things get too hard a year down the line, that you're not just going to pull out and leave me high and dry. So they want to see that you have some kind of skin in the game, whether it's money that you're putting in yourself, whether you're taking cash flow out and that's how you get paid. Some way they want to make sure that you are involved with this and will not just walk away and leave them, breathing in the wind. So it's not all about you. When you approach people with money, you want to make sure you know that you tell them what you can do for them. It's about them. It's not about you. And as long as you approach it that way, people are receptive. They don't want to hear you talk about you. They want to hear you talk about them and how you can help them. Do what you say you're going to do. Now, this should go without saying, but unfortunately it doesn't. And especially as you have longevity with building capital and building private money, again, that example I pointed to at the very beginning where we had to foreclose on that one property because the borrower walked away from it, we told the investors that we were going to pay them every month during the course of the project. So we kept doing that. And we felt so strongly because that we said, this is what we're going to do, that we wanted to keep going with that. And I tell you that nothing builds trust by going through something where your feet are to the fire. So do what you say you're going to do. You're not going to get in trouble, and you're going to build happy investors that are going to stay with you deal after deal. Transparency, that is huge in this whole conversation. You want to share details of what's going on. You want investors to feel comfortable that you just didn't take their money and left. You want to keep letting them know, hey, just checking in. Here's an update. Here's what's going on. Regular communications and be reachable. This is what we do because we have somewhat of a boutique business. Every single one of our investors, we have about 30 of them across the board. Every single one of them is in my cell phone and has a special ringtone. So all investors have a special ringtone called Presto, right? So I know when that phone rings, I get up from whatever I'm doing and I go answer it. And, 9 times out of 10, I either pick it up right away or I call them back right away. And because of that, the investors know they can reach us and they have a personal relationship with us. And they know that builds that trust, right, that we were talking about. So stay in good communication. Demonstrate a track record. Now, I know sometimes getting going, it's kind of like pushing a rock down a hill. It takes a little bit to get it moving, and it's not until you get it turning that things start happening for you. Once you have that track record, you want to use it. You want to be the authority. You want to come and do a Zoom call with a number of people and work with other partners that are also in the industry so that you can share your business and share what you're doing. You want to gather testimonials and have referrals. So we have a lot of testimonials that are written that we always get from people, but most of our investors, because they invest with us time and time again, we just ask if they wouldn't mind being a reference for us. So when we have a new investor come in, they have somebody that they can call and ask them whatever questions that they want. And we're fine with that, again, because we do what we say we're going to do. And we know we have these great relationships built up. And you want to make sure when you have a track record that you share your success. This could be over social media, this could be on your website, whatever it is. And really just, even at a party, you just want to talk passionately about what you do. Many times that is really what brings investors to you. You just share your excitement about what you're doing and how your business is going. And people will start asking more questions, and that leads to the conversation from there. So what if you have no track record, right? I know there are a lot of people like, we didn't have a track record when we started either. Nobody does. Some of the keys that you can do is borrow experience. And what I mean by that is to join forces with another investor that does. We did this, for example, when we started with storage. Aaliyah and I have this great track record of finding the money. Our partner, Al, already had been buying storage properties since 2007, and he'd been operating them, but he wasn't so good at raising the money. And we had no knowledge in how to actually operate storage. So it was a perfect marriage between us two because we could raise the money, and Al primarily handles the operations. Now, we talk once a week. We are as involved as he is in many cases in running the business, but it's a great way when you don't have a track record to get going. So I highly, highly recommend, again, going to Real Estate Investment Club, networking, and finding other investors that, again, have that complementary set of skills or experience that you don't have. So you can read through the rest there. Another one I'll just highlight down there is be willing to take a piece of the pie just in order for having the experience. So you don't need to come away and own the whole deal. You could actually ask somebody who is actively working a deal and see if there's a way that you can add value using your particular skill sets that you can leverage that then, and again, go through a partnership with them. Leverage your strongest skills, act with confidence, of course, and don't give up. Goes without saying. Concerns of a private lender. Now, when you meet people, and this is pretty obvious, right? I mean, we all have our own money, and you can imagine, even if you don't have your own money, how would you feel handing over, a huge chunk of that to somebody? What do you want? When will I get my money back? How much will it earn? How is the investment protected? So is there a security instrument that is securing that? I always like to say with stocks, a lot of people are familiar with investing in stocks. What is the security behind that? The company can lose value overnight and your money is gone. With real estate, it is backed, and we've got a security document, meaning either a deed of trust or a mortgage, depending what state you're in, securing that money to that property. There's actual bricks and mortar behind it, securing the investment. So that you always want to make sure that's clearly stated out and is explained to them, especially for people that are really only used to investing in stocks in the stock market. What risks are there? Always you want to sell out. This goes back to that transparency. Again, you want to talk about what you expect the risks to be and how you're going to manage them. And you want to talk about how their money is handled. For example, we only use licensed brokers, or we only go through a title company, a licensed title company. Whatever it is, you want to highlight those key points. Best practices that we have found. We have all of our legal documents, right, which are like 60 pages, 100 pages, they're written by attorneys, are full of legalese. We expect people to read through that, right? Because they're supposed to. That's what they're signing on the dotted line. But it always makes sense to have like your one-page cheat sheet. Or if it doesn't all fit on one page, maybe it's a few pages. But a document that's your investment summary, summarizes what you're doing. It's in layman's terms. It might have some graphics, some pictures of how money flows from them to your business, out where it's going. And it has all of the different terms on there. So that is key because people don't have a lot of time. And we've all heard the term, a confused mind says no. So if they're having to sift through all these 60 pages of documents, 100 pages of documents, they're just like, oh, I don't have time for this. Give me that cheat sheet. They can quickly see what you're all about and then decide if they want to take the next step with you. Use reputable attorneys, brokers, escrow, and title companies. Just talked about doing that. Of course, you always want to use your team to help you out. Provide updates as the deal progresses. This goes back to staying in communication. And we always have a rule of thumb. We want to call them first. If something is happening or payments are going out, we want to be the first one to reach out to them. If an investor calls us, they're always welcome to do that. But it's always like, hey, we haven't We haven't seen the quarterly newsletter go out yet. I'm typing it right now and it's just about to come out. We always want to be in communication first. Or if we see something happen along the way, we want to let them know first. You don't want to have your private lenders having to try to pull information from you. That does not feel good, and they won't like it and they won't stay with you. Manage expectations, under promise, over deliver, always good in any business and no exception here. Now, where does money hang out? How do you find all these private lenders? I'm not going to go through this whole list. You can read them there. Typically, you start with friends and family. You start with coworkers. And like I said, investment clubs are great places to start where you'll meet a lot of people. But basically, you can meet them anywhere. Again, be passionate about what you do. Talk about what you do, and you'll start the conversation. Creating a 30-second elevator pitch. Now, probably a lot of people have heard of this before. If you haven't, it's a good idea to have one in your back pocket. You can tweak it for your specific niche, but what this is and what it means, if you haven't heard of it, is if you were riding down the elevator with somebody and you only have 30 seconds from the time you get on to the time the doors open and you're stepping off, what are you going to tell them about what you do? So you want this to be fast, quick, and you want it to be positioned around what you can do to help them. So if they say, oh, what do? You don't just say, I'm a real estate investor. You might say something like, we help everyday people learn how to achieve financial freedom through storage investing so they can leave their 9-to-5 job and retire early. Does that make sense? Now, those key parts of it, we help X do Y so that Z in whatever your business is, and then does that make sense, opens up the conversation so they don't just go, oh, that's great. Does that make sense? Helps open up the conversation for more questions. Now, I have to say with an elevator pitch, sometimes this can sound forced. Depends where you are. It's still a good practice to go through because sometimes it's those key talking points that you want to pull out of your hip pocket to have with you. So again, I'm a firm believer in be passionate about what you do, talk to people about it, and you'll start those conversations. Bird dogs for money. Just doing another time check here. Great. Bird dogs for money. These are people that are going to help find people with money for you, and they tend to be people that are in businesses or occupations where they deal with a lot of other people. They see a whole bunch of, they see people come and go, and many times the people that come and go are normally going to be people that might have some money. So again, you can see the list here, and then we have a script down there at the bottom that is a good way to approach a potential bird dog. I know this probably isn't for you, but because you deal with a lot of clients, who do you know that would like to earn above average returns on their money secured by real estate? And by saying, I know this isn't for you, takes that pressure off of them feeling like you're asking them for money. And many times they might go, oh, well, wait, that's me. Or I know somebody just down the street, or I have this dentist. We love dentists, by the way. They're really, really good investors. We have this dentist down the street comes in here all the time, and I know he has a very good, big, thriving practice. Let me put you in touch with him. So great way to try to, again, expand your network. Don't wait. Start now. Don't wait until you are thirsty before you dig your well. Even if you don't have a deal on the table, you want to be thinking about raising money now. And again, talk about what you do. All right, a couple of key slides. Good, we're doing pretty good on time. Okay, I know it's late. I know we're getting towards the end of the day. Please wake up if you have fallen asleep during any portion of this, because these next two slides, and I've only got two more, so we're getting into the home stretch.
You're doing great, Terri. Really, you're doing awesome, by the way. Doing great.
Oh, good, good, very good. So we're in the home stretch here. I really, whether you're doing storage, whether you're doing note buying, whether you're doing single family, whatever you are doing, please pay attention to this. The SEC, Securities and Exchange Commission, at least here in the United States, has very, very strict regulations about raising money. And you see that little asterisk there? I am not an attorney. I don't want to present myself as one. I've just worked with a lot of them, so I'm sharing with you my experience and things that I've learned. But please make sure you get your own legal advice in whatever you choose to do. Disclaimer aside. Okay, so what you want to do, the SEC wants people to get a securities license, right? Before they start asking for money, they want you to be trained, they want you to go through their education program, and they want you to file so they know who's doing what in a specific kind of license for you to have that security license. Once you have that security license, you are free within the confines of whatever your particular license is to go out and raise money. If you don't have a license, which I believe most of us do not, then you have to be very, very, very careful with what you're doing. You need to have a relationship with somebody before you ask them for money. Now, we were just talking about bird dogs, right? And having somebody connect you to, say, a dentist. If I were now connected to that dentist, I wouldn't just want to go on meeting one or on my first phone call and say, hey, Dr. Whoever, how would you like to invest? We've got this great investment for you. We're giving this amount of return. We're doing this. You don't want to do that. You want to take them to lunch. You want to get to know them. You want to get to know their financial background. You want to make sure, and this is why the SEC does this, they don't want you to go after grandma who has her money under her mattress and is counting on that money to be her life support and to pay her rent. So they're trying to keep predatory lenders, right, from doing that, predatory investors from doing that. So that's why they really want you to have a relationship built up first. What does that mean? If you see the don'ts there, no public solicitation. So that means if you have a deal, you cannot put an advertisement in the newspaper and say, hey, I've got this deal, come one, come all. You can't go on Craigslist and post something, hey, come invest with me. You can't even pass out flyers. You have to be very, very careful with this. So let's say you're speaking somewhere, or I'm speaking on the call with you right now. I have to be very careful. I can't just say, hey, and by the way, if you want to invest with us, here's the rate of return we get you. Because I don't know you. I need to have a relationship with you. I need to make sure I understand if this is a suitable investment for you and you have the means or the wherewithal to give me money and to take a risk on investing, because any investment is a risk, right? So I need to develop that with you first. So no public solicitation, no discussing the rate of return, no email blast. Even if you have been developing your email list, let's say you have another business and you've got some people you know, if you don't know those people very well, or they're just kind of some colleagues, but you really don't know about their financial situation, you have to be very careful. You cannot do an email blast and say, hey, I've got this great deal. Here's the interest rate. Here's what we're giving. Here are all the terms. That looks like a solicitation. You can email them and say, yeah, we are in the process of purchasing this. If you're interested, come, give us a call. We'll take you to lunch and we'll talk with you through it further. Some of the do's around this. There is something called the 3-touch rule, although it's not foolproof. So again, not an attorney, but it's just kind of gives you some guidelines. You want to touch people 3 different times. Take them to lunch 3 different times. Really start to get to know them. What's even better, though, is to have a pre-qualification form. And this is what we do with all of our investors. We have a 1-page form. It's pretty simple. It just asks for their contact information, and then it asks them, what is your investment experience? Are you accredited, meaning you're a high-worth individual? Are you sophisticated, meaning you at least have some kind of investing knowledge in the past? And they write out what their investments are, they sign it, and now we have that in our files. So if we were to ever get audited by the SEC, we have that piece of paper to say, look, we did our due diligence on this person. They told us they were sophisticated. They have some investing knowledge. We could move forward with speaking to them about the terms of the deal. Many states have a Department of Real Estate, or like California now calls it the Bureau of Real Estate. Many times they have an investor questionnaire. That's like a 1 or 2 pager. So we had our attorney draft up our pre-qualification form, but in absence of that, you could check your Department of Real Estate for your local state and see if they might have an investor questionnaire that you could use. Watch what you say. Don't say under any circumstances that an investment is safe, secure, or guaranteed. Those are no words. You want to stay away from them. What you can say instead is the investment is secured by real estate. So the difference is by saying this investment, it's secure, lends the potential investor to believe that they're going to get their money back no matter what. That's not what you want to say. It's not guaranteed. It's secured by real estate. It's safer than stock because it's secured by real estate. But you're not going to say safe, secure, guarantee. So just strike those out of your vocabulary. You are also able to talk about above average returns. So if you can't talk about a specific interest rate, for example, you could say above average returns, double-digit returns. You just need to keep it a little bit ambiguous until you get a person qualified, and then you can start to go into the key point of your investment. Watch what you pay. So if you have a bird dog, you cannot pay them a commission because now you are acting like a broker without a license. So you can't say to, the bartender, hey, for every private lender you find me, if you can find me $100,000, I'll give you, 3% of that or whatever. That's acting as a commission. You cannot do that. You can, and this is actually a little bit of a gray area, but it's more acceptable to pay a flat rate. You also, and this is what I would do, I wouldn't pay a flat rate for finding an investor. I would pay it as a marketing fee, right? A little bit different than a salesperson. So you just want to be very, very careful with what you're doing. Again, this particular point is a gray area, so consult an attorney. All right, final slide, and that is when you are raising money from private lenders, again, you need to be very, very careful about the SEC guidelines for pooling money. And let me just back up and say, with the SEC, if you were to get in trouble or do things wrong, not just a little slap on the wrist and a fine, like you could be looking at jail time. So you really, really do want to make sure that you're doing this appropriately. So not pooling money, what does that mean? Let's say we have a deal. Let's say we're buying some notes and we want to raise money to help us go out and purchase that note. And we know we have, some investor A over here, person A over here has a little bit of money, person B has some money, person C has some money. And if we just put all those together, we have enough to go out and do our deal. Great, everyone's interested, everyone's on board. But that is illegal because you are pooling money without that securities license to broker that deal. What you can do is you can have a joint venture agreement between all of those investors and yourself. You can have a formal partnership with an entity. That might be an LLC, a limited partnership, or a trust. Or you might create a syndication, also called a fund. And let me go through I'll touch upon each of these just a little bit to give you, again, a hint, but you're going to want to consult an attorney. For a joint venture, it's going to outline who does what and what happens when things go wrong, and that's key. Typically, they talk about the D's, death, divorce, dismemberment. I think there might be a couple others in there too. But what happens if the project loses money? What happens if someone passes away? What happens if? Whatever the scenarios are. And you're also going to want to have an arbitration clause in there that will typically say that if something goes south and goes wrong, you're not going to sue each other. You're all going to agree to go into arbitration. It's a lot less costly for everybody, and try to work out your differences with a mediator. Now, the first time you do a joint venture, I highly advise getting a real estate attorney to put it together for you. They really don't cost that much. It's not thousands of dollars. It's more on the order of hundreds of dollars. They typically will have a template that they pull and can then just kind of rearrange it for your specific deal. Or if you find a template from somebody else, you might be able to send that to an attorney and just have them review it and make some comments, and that might be cheaper too. But I highly, highly urge you to get an attorney involved, because they will know specifics for your specific state and different clauses to include and not to include. And then once you have one, if you're doing deal over deal over deal, you can pull it out of the shelf, maybe have the attorney review it. It's going to cost a lot less money, but then you can use that one over and over again. So that's joint venturing. Formal partnership, LLCs are actually very easy to create these days. You don't even need an attorney to do it. We own every one of the properties that we purchase is held in the name of an LLC, and we just do them online. You go to the Secretary of State and you fill out the articles of organization, and you create your LLC. So they're actually pretty simple. Again, first time you do it, you're going to want to get some expert advice to help you go through it and to make sure you've got all the documentation in place. Now, one thing I will say with entities is that you need to maintain them. So you set up an LLC, or you set up a limited partnership, or you set up a trust. Those entities need ongoing maintenance to show that you're running it as a business. So for example, an LLC needs an operating agreement. A corporation, whether it's an S Corp or a C Corp, needs bylaws. Both of those documents perform basically the same function. It's really kind of the rules of the road that your LLC, your business, is going to follow. So you need to make sure you have that in place, and it's adopted and signed by all of the members, and it really should be notarized, so you have it date stamped too. Then every year, you're going to want to, at least once a year, do an annual meeting and have annual minutes from that meeting. Now, if you think about this, if you were truly running like a large business or a corporation, every time you meet, somebody would be taking meeting minutes. You would log those. Every time there's a decision to, let's say like with one of our storage properties, to go out and put on a new roof. That would be a resolution that we would put into the meeting minutes of the company. We have done that on a lot of the bigger things, and we just keep track of them. We keep them in our binder, or we actually use like a Dropbox folder that we can upload them, and that's our corporate binder. But you want to at least make sure you do that once a year. If you're not going to do it every time you meet, by doing it at least annually, that will show the SEC or a judge, should you ever be put in front of a judge, that you are actively treating this as a business and running it as a business. So make sure you understand what the regulations are, again, for the state where you're filing that LLC, which we file it wherever the property is located, and make sure you follow those laws. Attorney will help you. And finally, a syndication. This is kind of the mamma jamma of raising money, right? As I mentioned, we have a syndication. It's called the Capital Storage Fund. We also had a syndication a few years back for note buying, so we've done that as well. And syndications are a little bit the next level because you definitely need to use an attorney, and it's going to cost you. The cheapest we've ever really seen is about $15,000, and I've seen them all the way up to $100,000. Just depends what attorney you go to and what services they provide you. So it's going to cost you some money. But once you get that ball rolling, like I said, if you're going to do deal over deal, you need to make sure you're doing this right if you're working with other people's money. Now, what is a syndication? Sometimes called a fund. You may have heard the term hedge fund. Those are typically for stocks, where they create the syndication, they create this fund for the purchasing of stocks. What we're doing is we're creating this fund for the purpose of buying storage properties, or for the purpose of buying notes, or for whatever purpose is that you've set out with your business. And there are several types of syndication. And each one has little different nuances to it. One type, you must only use accredited investors. Again, those are those high value investors that have a net worth of $1 million or more. Some you can take up to 35 sophisticated investors as well, and that's what we have. So we have a mix of accredited and sophisticated investors that we use. Now, our attorney then, once we decide what type of syndication we have, she actually files with the SEC that we are doing business under this syndication. So it basically is saying that no, we are not securities, we don't have security licenses, but we are doing business and we are filing with the SEC to let them know that we are doing this business, and this is how we're running things. This is what we're doing. And that keeps us legitimate. And now the SEC feels better, right? Because they know what we're doing. We're on record for them, and we paid them money to do it too. So the parts of a syndication, now that you've decided what type, you've decided with your attorney what type, you've paid them the money, you've done the filing, you're going to have several different documents with this. The first is a private placement memorandum, also called a PPM. And this is very similar. If you're used to stocks, you might have a prospectus on what the company is doing. PPM is very similar to that. It's just going to lay out what your business is. Here's what we do. Here's how we're going to use the money, and here are all the risks involved. And that's going to be pages, right? Because it's going to be filled with legal terms and legalese of if there's a nuclear event, and if there's a catastrophe, and if there, all of the different things, but that's going to protect you. So that's your private placement memorandum that, again, just outlines what you're doing with your business. The subscription agreement is a separate document, also a legal document. That one's a little bit shorter. Ours is about 13 pages. And that is just where the investor signs on the dotted line and saying, yes, I am subscribing my $100,000, for example, into your company to do this, and I agree, and here's all my information, and here's all the particulars of that, and then they sign on the dotted line at the end. So private placement memorandum describes the business. Subscription agreement is the actual agreement that is signed by everyone. And again, in order to do a syndication, you're going to want to hire an attorney. Don't just hire a real estate attorney. It should be a securities attorney. They specialize in pooling money. They specialize in doing all of this. Once you have the fund up and running, you're going to want to manage it a certain way. The attorney can help you do that. Just real quickly, I don't have this on a slide, but I'll just mention it here, that we put out a quarterly newsletter letting our investors know what is going on with our business, what's going on with our existing properties, any new properties we're looking at, a little bit about the storage industry. We do that once a quarter. We also have a conference call for all of our investors. It's optional. They are welcome to jump on, and we can talk as a group about what's going on and answer any questions. Now, I mentioned our investors always have our mobile phone number. They can call us at any time. So many times they don't come on the conference call because they know they can just pick us up and pick up the phone and call us whenever they have a question. But there is a little bit of ongoing maintenance for that, but it is a lot easier to have the maintenance of a syndicated fund because it is just a quarterly newsletter versus some of the other hoops you need to jump through by some of the other ways of pooling money. And again, the biggest thing about it is expensive, but when you are doing more than just a few deals, you're going to want to look into it. You're going to have to look into this in order to keep your business clean and to keep yourself out of trouble. So with that said, thank you so much for your time. I think I am right at time, actually. I have our websites here. If you want to check out our fund website and see what one looks like, check out capitalstoragefund.com. Again, Investors in Action is more of our education side of things, /learn. If you want to learn more specifically about storage, you can get information there. And if you're interested in contacting me, happy to do that. My email address is Terri, which is T as in Thomas, ERRI, .investorsinaction.com, or Terri@capitalstoragefund.com. Either one works. They all go to the same place. So thank you so much for your time. I hope this is some good information no matter what your investing class is. And again, go for it. Good luck to you, and thanks so much.
No problem. Just got a couple questions here really fast for you.
Sure.
Michael asked, would you ever build a new storage facility versus buying existing?
You know, that's a great question. We don't. That's just not our business model. There is nothing wrong with that. But let me tell you why we don't do that is because when you build from the ground up, you're raising the money, and now you're having to build, and you're starting from zero, right? You have nobody there, so you're having to market and bring people into your storage facility before you start getting cash flow and can pay your investors back. So there's nothing wrong with that, but we prefer the model of finding a property that's, say, 50% occupied, because then on day one, as soon as we close, we've already got some cash flow coming in that we can use to pay the bills. We don't have that pressure of having that lag time until cash flow comes in. But yet, there's still room for us to add value to the property. So we also will pass on storage properties that are 90% full. We can't do anything with those. And a lot of the bigger REITs will purchase those, like Public Storage. That's a publicly traded storage REIT. And they specifically will look for properties that are already functional, already up and running, and in the 90 percentile of occupancy. That's just not our wheelhouse. So we don't go to the already fully occupied. We don't go to the ground up. We're right in the middle where we've got some cash flow, but room to add value.
Question for you. How are you marketing the facility? How do you increase the occupancy of your self-storage? Are you using robots to replace the manager with occupancy? Or are you doing more billboards or flyers, or it probably depends on each location, right?
It depends on each location. That's a great question. However, the simple answer is across the board, we have a website, right? And we also advertise online. There is a website called it just slipped my mind. There's a number of aggregators that will bring in storage sites across the board. And it sounds simple to have a website or do online advertising, but many of these mom and pops, again, they've been advertising in the yellow pages. So which doesn't do anything, right? Most people are going to find your property online. If you wanted a storage property, you would type in, storage San Diego or wherever you're located. Right. And so you want to make sure you have an online presence for sure.
Yeah, makes sense. Izara was wondering if they could get a copy of your slides. They really liked your slides.
Oh, well, thank you. Yes. Yeah, that's no problem. What do you want me to do, Scott? Send it to you?
Just email. If you want to put it in a Google Doc and email me the link, that'd be fine, and I'll get everybody's stuff to them.
Okay, sure thing. Yeah.
And then
Marlene was asking. Disclaimer: I'm not an attorney.
Yeah, we got you. Not attorney. Marlene asked, "How are you managing storage properties in 13 locations, on-site or remote management?"
We have remote managers. So another great question. All three of us are partners are in San Diego County. So we obviously, when we're purchasing, we always do a site visit because we want to check a radius of 5 miles around the property. That's very key. Most people, when they rent, they do it based on price, and they do it based on 5-mile radius. They really don't want to go any farther out there than that. So we will do a site visit, and we will look in a 5-mile radius. Now, we will tend to keep the on-site property manager that we inherit with the property when we buy it, and we give them a chance, right? because we want to find out, did the property lose occupancy because the owner stopped caring, or was there a concern with the property manager? If the owner cared, though, they would have fired that manager and gotten somebody else in there. So typically it's with the owner. But we will keep a property manager on site. Many of them, of the original ones, are still with us. We have had some that after about 6 months or so, it's pretty obvious they're not working out, and we get rid of them and have to bring somebody else on. But we like having on-site management because it provides an extra layer of security, it provides better customer service, and it also helps us, they many times have a lot of downtime, so we'll have them do the weed whacking and do some marketing locally around town.
Cool. Can you speak to the importance of having reserves in order to pay your investors in case of a crisis?
Do we have reserves in order to pay our investors?
No, can you?
Is that what the question?
Yeah, kind of. Can you speak to the importance of having reserves in order to pay your investors or your lenders in case of crisis?
Yeah, okay, very good. So, I mean, yeah, it is what it sounds like, having reserves. So, again, this goes back to doing what you say you're going to do and making payments on time. And the deal that I gave you of when we were doing that fix and flip, we were only able to pay investors because we had reserves. So, you know, and as you're getting out, as you're getting started in your business and just starting out, it might take a little time to build that up, but, you know, a little money to the business, a little money to reserves, and you keep building it up, and you want to make sure you've got funds in there to cover, you know, anything that's going on. Now, the other thing with that, let's say there's a hurricane, or let's say there's a fire or a tornado and it wipes out your facility. We have insurance for the property that also covers loss of rent. So if the property completely gets wiped out, we're getting that subsequent rent, and we do it for 12 to 18 months. It kind of depends on the area. But we know then that we're going to keep making the rent while we are rebuilding and using that insurance money. So that also helps us. So we have reserves, but that also helps us protect our investors.
Last question. Can you mind defining secondary and tertiary markets for them? How can they identify them?
Oh, sure. So you have primary markets, secondary, and tertiary markets. A primary market are really just the top MSAs, top metropolitan statistical areas. And that like they use that for census, all of that. Just at a real kind of layman's terms, secondary and tertiary markets are going to be things like Abilene, Texas. Dallas would be primary. Houston would be primary. San Antonio, I would really even, and Austin, I would say are primary. Abilene.
Hey, don't be knocking us here in Austin now. Come on now.
Well,
Woodside and Ton is saying, come on now.
Yeah, that's funny. Brownsville, Texas. Let me see. Some of the other cities we have Shreveport, Louisiana. New Orleans would be primary. Shreveport would be secondary. We are outside of Atlanta. Atlanta would be primary. Warner Robins, which has a military base nearby, is a couple hours south. Secondary, even really a tertiary market. So it's you know, if you've heard of the city, it's probably a primary market. If you've kind of heard of the city, but you wouldn't fly there, or the airlines wouldn't hub there, then it's probably a secondary or tertiary market.
Right. That makes sense. And we got time for just 2 questions, so that's it after these 2. Marlene asked, what's your exit strategy with partners? Are you
with partners in investors?
Yeah.
I'm going to assume. So our exit strategy, if we as the 3 business owners, if we have a property that we want to hold, then what we do is refinance. So for example, on Owosso, that's exactly what we did, where we brought in investors for the down payment. We got a commercial loan for the balance, and that's how we purchased the property. We took the property from 67% occupied all the way up into the 90s. And we brought in the U-Haul trucks, all these other streams of income. So now the property is making more money. We can now go to a commercial lender again and say, okay, when we first bought the property, it was making this amount. Remember that equation, the net operating income divided by the purchase price is cap rate. So it was making this amount, meaning the value of the property was what we purchased it for. Well, now that we increase the net operating income, increase expenses, or increase income, decrease expenses, we now have the value at this amount. So they're going to loan to value of, let's say, 70%. That 70% is going to be on a higher value than it was originally. So now that amount of money, and this is what we determine when we're going to actually implement the strategy, now that amount of money we can pull out from the property used to pay off the original first position loan plus our investors. And now we have just one loan at what we hope is at a very nice, 5%, 6% interest rate, low across the board, and now us as owners, we're making the money instead of paying it to our investors.
Great comment. And then last question, you have any secrets to how you're finding some of your deals? Are you mailing to direct donors, or what are you kind of doing?
Good question. The way we get our deals, certainly now, is by brokers. When I mean brokers, I mean storage brokers, real estate brokers. So just like you have a real estate broker to buy a single family home, there are commercial brokers that specialize in storage, that specialize in self-storage. And we're on all of their mailing lists. So we see their inventory come to us. And because we've now done 13 deals, they know we're serious. They know we'll close when we say we're going to close. Many times we get pocket listings from them, meaning they will contact us before it even goes out on LoopNet or any of the other MLS type websites, and they will say, hey, we've got a deal. It seems to fit your wheelhouse and be the type of property you like to look for. Are you interested? And then, yay or nay, we'll investigate it and go from there. So the majority comes from brokers. If you're just starting out, we did this a little bit at the beginning. You can just call storage properties and ask them to see if they're tired sellers, but that's a lot of effort. I really think the brokers is what I would recommend. Another strategy, I'll leave you with this one too, is you can go online and again, Google storage San Diego or storage, because we don't buy properties in San Diego, too expensive. Let's say storage Abilene, and you have all the storage units that come up. Well, the ones that are like on the third, fourth, fifth, 7th, 8th, 9th page of the search listings are not really optimizing their search engine. And therefore, you have to assume that those owners are not advertising or utilizing their online presence as much as they could. That's an indication of a mom and pop organization because they're way back in the listings. And so you might then call them and just say, hey, are you tired of doing it? But again, that's a fair amount of work too. I really encourage you to use brokers because just get on their mailing list. They will also provide you information, and this is another great thing about working with them. When they have a deal, they will give you a marketing packet that tells you what the population in the area is, what the median income is in the area. They'll give you pictures of other competitors in the area. They give you a lot of information and really do a lot of the work for you.
You have been awesome as always, Terri.
Oh, great. Oh, and I just thought of the name. That aggregator website is called sparefoot.com. Sorry, it just popped in my mind.
Awesome. Well, I want to thank you so much. Great knowledge, great nuggets. I know everybody here says, yeah, I've seen thank you. People post on Facebook as well, too. Great session. Thank you so much for taking time on your busy Saturday in the heat there, pulling mustard greens, all right?
Yeah, exactly. I'm going to go get to it now. They're starting to cool off. So thanks, everyone. Appreciate it, and good luck. Whatever you choose to do, good luck. Keep going. You can do it.
Great, then. Thanks, Terri.
Okay, thanks.